I started my investment journey more than 20 years ago. So for 20 years, I have been an investor, and I've spent 10 years in business, which also is a form of investment. I explain to people that business, when you run a well-managed business, it's like the superhighway to wealth, because nothing is going to get you more accelerated returns than a business. And investing, when it's done well, is what I consider to be the slow road to wealth. So business is the superhighway to wealth, and investing, when done well, is the slow road to wealth. Now, obviously, when you're on the superhighway, you have more crashes because you're going fast. Whilst the potential to make a lot of money and a lot of returns is very high in a well-managed, well-systemized business, the reality is that a lot of business people fail because they don't have the skill set and the mindset that is required to run a successful business. For a lot of people, they don't even have the desire to build business skills. So for them, it may be that they choose to secure their financial future and create financial wealth for themselves and their family through investing rather than through building a business, which is fine. And when it comes to investing, the two preferred vehicles that have always been used by wealthy people to create at least the foundational level of their wealth have always been stocks and shares and real estate or property. They don't do a lot of fancy things until they have made a decent level of wealth. So they don't go into private equity funds or hedge funds, or they don't go into, like these days, you see a lot of people that have not created the first level of wealth and they're starting their wealth creation with cryptocurrency. Wealthy people now, you'll find that majority of them have made their wealth through the traditional asset classes, real estate, stocks, and businesses. Now, in this video, I really want to talk about real estate because I've had over 20 years of real experience in being a real estate investor, apart from being an investor in stocks and businesses. And I just want to take the opportunity here to talk a little bit about what are the key considerations if you want to be a good real estate investor. And I'm going to talk about not so much the planning around it, but some of the strategy when we are looking to buy real estate. What are the key considerations in terms of what are the things that make an investment property a good investment? So the first thing that makes an investment property a winner is the location. Location is the most critical consideration because if location is right, even if the actual property that you buy is not the best property, well, a lot of the money in real estate is made through capital growth or capital gain. And a lot of that capital gain or capital growth actually happens if you buy in the right location. And so what does it mean when we talk about the right location? What are the things that we are considering in the location? Well, the first thing that I look for is that the location has to be desirable by a demographic that have affordability and purchasing power. So I will look for locations where there is a very high concentration of owner-occupiers, meaning that more people live there than rent there, because that's an indication that property prices may be quite expensive. And I look for an established location. So for example, here, if you just have a look on my right, and as we're driving, and I'm just going to put the windows down a little bit to show you some of the things that I will be looking at to determine if the location is a desirable location. So I'll do some research on the internet, but I always like to drive through the locations as well, just to get a feel for the area. So I look for established streets and I look for established houses. And of course, if there are more established trees, then that's telling you that it's an older area. I'll also look at proximity to a major business district because of employment. I'll look at proximity to transport facilities. I'll look at proximity to medical facilities, because a lot of the wealth is actually held by older people, and older people will typically start to have health problems, and so they will want to live close to where the main hospitals are, main clinics and specialists are, because then they can easily access those medical facilities. Now, as I look around this area, I see that this is quite a nice area, but I don't just want to get seduced by how nice it is On the outside, I'm actually looking at certain things. I'm looking at how established it is. In this area, I can see established housing, but I can also see that there is not a lot of apartments. So, for example, there are some nice houses. We can see that people have made some significant expenditure. They've made some significant investments in these properties. So what we're seeing now is that there is money in this area. It may seem like an obvious thing, but a lot of people don't consider all of this stuff. And so I'm looking at not just the fact that there are schools and medical facilities and transport facilities in the area, which I've already verified. I'm actually now looking at how the streetscape works. Are people looking after their homes? Is there signs of damage and neglect? But it seems like here most of the people have mowed their grass. You can see that they've maintained their properties. And all of that is telling me that there is quite possibly a much higher concentration of owner-occupiers, meaning that people who actually live here, because tenants typically will neglect properties or they will not look after properties as much as owner-occupiers will. I'm also looking at the number of cars here. So I'm seeing that there is a lot of, obviously, population growth because the fact that there are so many cars and there is so much traffic is also telling me that there is a lot of people that live here. So that's the first thing I'm going to look at is location, and everything that I've just mentioned that falls under location I'm looking at. I'm also looking at whether there is employment facilities. So on my left, which you didn't see, there's a lot of commercial offices and things like that. I'm starting to feel that there are cafes and restaurants and there are shopping facilities. So I'm just going to drive into this shopping center here and I can see that there's a lot of cars. So that's an indication also of the fact that there are people that are quite active and it's a vibrant community. You can see the vibrancy in the community. So that's what I'm looking at in addition to everything that I've mentioned when it comes to locational considerations. The second thing I'm looking at is this place going to have good rental demand and continued rental demand? And so for that, I'll look at whether there is a community feel. And, are there families? Are there cafes? Are there restaurants? Are there great shops? And so again, all of that's telling me that that's going to produce desirability because people want to be around nice things. They want to be around community. When they see that there are people around and they're shopping, they're having picnics, then also that's telling me that there's going to be potential rental demand. Along with, remember all the things that I mentioned from a location perspective, if there's medical facilities, transport facilities are very important. And from a rental demand perspective, I will look for a property that has proximity to public transport, but it is not so close to the public transport that you can hear the buses and the trains. So I want to be close enough within walking distance or a very short driving distance, but not so close where you can hear all the commotion. Because if you're very close to a train station or you're very close to a bus station or something like that, what happens is you're going to get a lot of people around that area. And so that can reduce the rental demand in a place where people may want some level of privacy and quiet. You just have to balance that. You want a place where there's high rental demands, and you've also got to think about what kind of tenant you want. For me, it's about wanting a tenant that has had rental history, that has stable income, that where there is more than one income earner, because that reduces my risk. If I just have a single person renting my property and then there's only one income and there's any disruption to that income, then that can reduce the cash flow from a rental perspective, or it can disrupt the cash flow. But if I get, say, a couple, a family, or two relatives, mother and daughter or something like that, renting the property, then that's increasing the possibility that when there's multiple sources of income coming into the household that is renting the property, then that simply, to me, that represents a lesser risk of disruption in cash flow. So I would consider those types of things when I'm looking at rental demand. The other thing that you want to look at is if the street has unique appeal, or the house or the facade has a unique appeal. That is important because if there are features of the street or the facade of the house that cannot be replicated, then that can also create strong demand by other people who may want to buy that house down the track in the future or may want to live on that street. So I look for unique elements. For example, it's very difficult to create streets with big trees because all of these things give the street character. And if the house is up on a slope as well, then that is something that's difficult to replicate. Now, this is not just in regards to attracting a good tenant, but it's also about considering future capital growth. Because if there are unique features, then that property is going to be a lot more in demand, especially by people who have money. And that's how you increase the value of that property. Another critical thing that I want to look at is the ratio of investors to owner-occupiers. So for example, in this particular development on my right, this project, I see that there is not a lot of units or apartments. So we can see that this is a brand new project, obviously. I want to find out through my research is the ratio of investors to owner-occupiers. The reason is very simple. When I'm buying a property for the purposes of renting it out, meaning it's an investment property, I want to maximize my ability to attract and retain good tenants. Now, if the ratio of investors to owner-occupiers is very high, then what happens is when I rent out my property to attract the right tenant, I have a lot of competition at my doorstep, because every person who is also an investor in the same complex will be renting their property out. And so we're all competing for the same tenant. That can create issues, because then that places all the financial power in the hands of the tenant as opposed to the landlord. So this is something I want to consider very carefully. And that's why I'm not very keen to buy in high-rise apartments. And the other thing that we need to also look at is when you buy in a high-rise apartment, you've also got to look at the costs of maintenance. Typically, you're going to have some sort of a committee in a high-rise building that will be responsible for the cleanliness, for the manicured gardens, to make sure that the facilities are working, if there's a swimming pool or there's a gym or there's lifts. All of that is going to incredibly increase the cost of you holding onto that property, which can potentially diminish your return if you have not factored in how much rent you're going to get for that property and you've deducted all the costs from that rent. Sometimes people will just look at the money that they're going to make, but they don't factor all the costs in. But if your costs are very high on an investment property, then that is eroding your return. And so there's no point getting emotionally attached with a property and saying, oh, this is a great property, it's beautiful, look at the view, look at the windows, look at the sunlight. People get emotionally attached, but they don't look at the numbers. And as investors, we are predominantly concerned with numbers, because it all comes back to ROI, the return on investment. It is not about the aesthetics. I mean, it is about the aesthetics up to a certain point. What point is that? Well, up to the point where we can determine that the aesthetics are going to attract the right type of tenant, the type of tenant who has money, the type of tenant that is going to want to live in that property for the long term. We don't want to look beyond that. We don't want to start fantasizing about living in that property, because that's not what it's about. It's really about making sure that the ROI, the rate of return, and we want to look at the net rate of return, not just the gross rate of return. And we'll talk about that, how you calculate that, but you want to look at the net rate of return. And for me, the net rate of return is how much income I'm going to make from that property, deduct all the expenses, and then also look at costs and taxes on what I'm going to pay on the net income. So cost meaning that there might be costs of holding the property, but also if you've got a loan against that property, then you're paying interest on that. I want to factor all of that to work out the net rate of return. That's very important. A lot of investors don't do that. They just get emotionally attached to a property. They get emotionally attached to a location. They don't apply an objective criteria for selection. And so what happens is they end up losing a lot of money, because so many investors are not trained in being able to calculate the opportunity cost of what they're losing. What happens is they tell people that they own 5 properties or 10 properties, and that's completely immaterial and irrelevant, because ultimately what it's about is how much money did you make and how much wealth you created, because that's why you buy an investment property in the first place. So one of the things I want to consider also is how this particular investment property fits in with my overall portfolio. As much as possible, even within an asset class, meaning like within, just like we would diversify in a share portfolio, when it comes to real estate, I want to be diversified within real estate by either picking a mix of residential, commercial, industrial real estate, or even within residential real estate, I want to have a mix of different types of properties in different locations to minimize concentration risk. So I might look at, for example, 1 or 2 apartments. Some of them may be boutique apartments. I may look at a couple of townhouses. I may look at a couple of houses, and just kind of mix it up based on, and there has to be meaning to this, by the way. This is not a random process. If you have a portfolio that is producing a lot of income, you may need properties that are producing capital growth to balance that. If you don't have that, then you may find that you don't have enough equity in your portfolio to be able to continually go to the bank and ask for money. On the other hand, if you have a lot of capital growth but you don't have income, then that's going to impact your serviceability to be able to, again, go back to banks and borrow money. And borrowed money typically works well for investors who are investing in real estate because of the leverage that it provides, which is something that I'll talk about in another topic. But these are some of the key considerations. It's not just about diversifying by randomly picking a mix of apartments, townhouses, and houses. It's about knowing what is right for you based on your need, in terms of your need for income, your need for capital growth, and your need for tax benefits. And based on the character of your current portfolio, you have to consider all of this to determine what is the optimal mix of assets within an asset class, and even when you look at all the asset classes together, to make sure that you're not taking risk and you're maximizing your probability for a high return. One of the other things that you want to consider is the yield. Yield is obviously a very important part of the financial return, and the yield is simply the income on an investment property. And the way you work out the yield is you take the annual expected rental income and you divide it by the market value or the purchase price if it's a new investment property. And you times that by 100. You multiply that by 100, and that gives you the yield return. Now let's just say I'm getting a certain return on a property annually, or let's just say the rental is monthly or it's weekly, but I convert that into an annual figure. Once I know what that annual figure is, I divide that by the market value of the investment property or the purchase price of the investment property. And if I multiply that by 100, that tells me what the return is on yield alone. So let's just say the yield return is 4.5%, which is the rental that I'm getting. And then I look at all the other factors that I've talked about to then also get a return on capital growth. Let's just say the capital growth return is 6%. If I'm getting 4.5% on yield and I'm getting 6% on capital growth, that's 10.5% return. Now, 10.5% return simply means that if I hold on to that property for 7 years and I can continue to get an annualized return of 10.5% for 7 years, then I double the value of my property. Okay, and that's without any tax benefits involved. So this is why real estate, when done correctly, not just randomly, not just sporadically, but done properly and correctly through analysis, through research, can be a great vehicle for wealth creation for investors. And this stuff is, it's not just about getting emotional. It's not just about acting on your instinct. Whilst instinct is important, many times instinct is built after a lot of evaluated and diversified experience. So when people think that they just have an instinct for something and they don't have the experience, there's a pretty high chance that they're going to make a wrong decision, right? So there is the type of instinct that is inherent in us, and there's the type of instinct that you develop through experience. You want the latter type of instinct when you're making investment decisions. Another characteristic of a winning investment property is the ability to maximize depreciation. So depreciation in accounting terms simply means a loss in the value of the building. And in different countries, they apply a different rate, they assume a different rate at which the building is depreciating. It's generally understood when you're buying real estate that land appreciates, but buildings depreciate. So what happens is when buildings depreciate, you're not actually physically losing money, but it is assumed that partial value of your investment is starting to get eroded. Now, this is considered a loss, and therefore you are able to claim depreciation, which is not an income loss, it is not a cash flow loss, it is simply an erosion in the value of your building, but you can claim this as a tax deduction. And by claiming this as a tax deduction, again, you're maximizing your returns in real estate, which is what makes real estate such a fascinating investment if you fully understand how to apply the strategies that maximize your return on investment. Another thing that can also be a contributor to a winning investment property strategy is the ability to make improvements. Now, this is more relevant for investors who are already cashed up and don't need to borrow all the money that they need for the purchase of the investment property. So what they can do is they can use a percentage of their own capital to do quick cosmetic improvements on that property, which will not just enhance the rental return, but also it will improve the capital value if
you are able to buy under market value. And there is a higher probability of you being able to buy something under market value if it is something that is not already improved, meaning that it's had a lot of massive wear and tear. It probably needs a new carpet, it needs new paint, it might need a new kitchen. So those are the types of properties where there's potential for you to be able to buy that property under market value. And if you're cashed up, you can quickly make improvements, and those improvements can result in higher income as well as capital return. Now, one of the things while I'm talking about this is the fact that behind me you'll see that there's a range of units. Typically, I would not be interested in buying units that are very uniform in structure and appearance. The reason is there is no character in those. Now, I'm not in any way criticizing these, but from an investment point of view, if I want to get a lot of capital growth, I want to find properties that have some unique characteristics. And when I look at properties that look identical to each other, then I know that my ability to be able to get capital gain on those properties is going to be diminished.
And of course, one of the key considerations around buying an investment property that has winning potential is the price. If you can procure an investment property under market value, even if it's a few percentage under market value, you can start with building equity to start with. Equity is the difference between the market value of your home and the amount that you owe on the property. So if you can buy something under market value, you're very quickly building equity in it. But even if you're buying at fair price, that's not a problem either. What you don't want to do is you don't want to overpay for a property. The reason is very simple. Property performs in cycles. It doesn't continually go up, it doesn't continually come down. There are long periods of stagnation where the properties plateau in a particular area. But then after that plateau, they typically end up going through a rapid increase in property values, and that's followed by a slight decline. And for that reason, you want to be able to hold on to a property for the long term. And so ideally, you either want to buy the property under market value or you want to buy it at fair value, so that you have the ability to be able to hold on to the property for the long term and maximize your growth. Whereas if you buy property at more than market value, then obviously your growth potential is going to be compromised, because even if the property market goes up, you are now just coming at market value if you ended up paying too much. So these are all the key considerations when it comes to buying a winning investment property. A lot of people just assume that buying an investment property or becoming wealthy as an investor is just about buying something. And a lot of people have not worked on their ability to critically analyze. And so even when they make investment decisions, they make what we call suboptimal investment decisions, which are decisions that are not going to give them the best outcome. So understand that investing is not, whilst good investing is passive in the long term, in the beginning, when you're making a purchase decision around a good quality asset, it is an active endeavor, because it requires a lot of thinking, it requires a lot of analysis, it requires a lot of research. If you're not prepared to do that and you just want to operate on a hunch or an instinct or somebody's tip, then what you're going to do is you're not going to create wealth. And when you don't create wealth, or worse, when you lose money, it's going to put you off investing. And then what that's going to mean is that you'll never ever be able to create wealth for your family and your future.